Hey Bowtie Nation, Joseph Hogue here with something completely different for our August 2021 portfolio update, something I've never done before on the channel. Now, I'm always getting ideas for stocks to buy from you out there in the nation, from the comments and in our Facebook group. But for the first time, I'm letting you directly decide which stocks we add to the portfolio. So I asked in the Facebook group, what's the theme you're watching for the rest of the year? And the 3 stocks you'd buy for August. Which stocks will outperform for the rest of the year? In this video, we'll do a quick review of the portfolio, show you which stocks have jumped higher, and what we've learned from the losers. I'll then dig into the stocks that you're watching, analyze those, and reveal the 3 stocks I'm buying for August 2021. I'll leave a link to stock card in the video description below. Click through and then go to Portfolios in the top menu. You'll find the Bowtie Nation portfolio in the Stock Picks section. It's free to follow, and you'll get email notifications whenever I buy or sell from the portfolio. And as a special bonus, I've negotiated an exclusive discount for all you out there in the community. Use the promo code BowtieNation, that's all one word in lowercase, for an exclusive discount beyond the free trial. We're getting started, but I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. So I want to jump into stock card here and do a quick update to the portfolio, but I also want to get in on those stocks that we're watching for August. The portfolio is up 27% so far, beating the stock market index by just over 12%. And while that's down from outperforming by 25% at one point in the year, it's still a solid return for 7 months. And our biggest wins here have really been in 3 sectors, really getting a boost from stocks in the energy, financials, and healthcare parts of the market. We were up 163% before closing out our position in Diamondback Energy and up more than 55% in both Wells Fargo and Citigroup. We're up 42% in shares of CVS, and I still think that one has a strong upside left. And now that recent performance is because a lot of these reflation sectors, the energy stocks, banks, and healthcare have started coming back down, but I still believe these are 3 of the best sectors you can be in for the rest of the year. And especially if you have a lot of your money in tech stocks, adding stocks to your portfolio from these 3 sectors, it's going to really help smooth out your risk because it's really been a tale of 2 markets, right? Either tech is up and the reflation trade is down, or these sectors are holding up while tech plunges. And now on the other hand, where we've had our biggest misses with the portfolio is in these reopening stocks like Cinemark Holdings and Madison Square Gardens, down 28 and 15% since adding them back in March. We've also seen weakness here in the small cap miner Nexo Resources and trucking company US Express. Now that whole reopening theme has really stagnated since March. The stocks just ran up so far, so fast since last year that now they need proof of that rebound in the earnings, and I still think we get that over the next few months. Now, shares of US Express are a little more frustrating though because it's a solid company on growing sales, so I think it's just a matter of time here as well. And now that 27% is pretty good, but I wanted to reach out to you out there in the nation to add some growth to our portfolio, see which stocks you're watching for the rest of the year. So let's take a look at some of your ideas, and then I'll reveal the 3 stocks that we're adding to the portfolio for August. Now, David here doesn't offer a theme or stocks to buy, but he says he wants 10% plus dividend yields and high growth potential. Well, yeah, and I want to shit solid gold turds, but we both know that's not going to happen. I understand what you want here, a good dividend yield and price appreciation, but you have to understand there is a trade-off between the cash a company can return to shareholders and how much it reinvests for growth. If a company is paying out a 10% or higher yield, it's probably saving little or nothing for that growth. And if it's in that high growth industry, that failure to reinvest is going to mean it's going to fall behind the competition. So a lot of times you're going to have to pick between one or the other, either a really high dividend yield with little growth or a high growth stock, but not much in a cash return. Now that does not mean that you can't get solid dividend yields and price appreciation, but please do not go chasing those high dividend yields exclusively. Look for that total return in the stock, so dividend yields and price growth. And here I'd say that you're best off looking between 4 to maybe 5 or 6% yields in real estate stocks. In this theme, I like Medical Properties Trust, ticker MPW, for a 5.4% yield, and EPR Properties, ticker EPR, which pays a 5.7% dividend. Derek wants to look at hospitality stocks that pay reliable dividends, so looking for the cash payout on those stocks recovering as things get back to normal. And here, I would actually expand this out to all those reopening stocks, so maybe include some of the different segments of the travel industry. But for that idea of a reliable dividends, you really do need to be paying attention to the balance sheet on these. A lot of those companies just loaded themselves up with debt just to survive last year, and that's going to weigh on cash flow going forward. So, what you can do here, once you find that good dividend stock you like, you want to go to the balance sheet, and we'll use LCI Industries here, ticker LCII as an example. The company is a parts supplier into the RV market, so right in that travel and leisure idea. And here you want to look for things like the current ratio, which are the short-term assets divided by the short-term liabilities. That's going to be a great measure of near-term liquidity for the stock. You also want to look at the debt to equity ratio, which is how much of the company is actually owned by lenders and how much is owned by investors. Now, these two alone are going to give you a sense of how sustainable that company's debt position is and the safety in those dividend cash flows. LCI pays a 2.5% yield, and to that I might also add Travel and Leisure, ticker TNL, which pays a 2.1% dividend. Sean is looking at the mortgage space longer term, but for shorter term ideas, he's looking at the stocks in the semiconductors and mentions Intel and Vishay Intertechnology, ticker VSH. And now, while some analysts think we might be able to work through that semiconductor shortage within the next year, on that surging demand for chips in everything from cars to household products, I think this is going to be an issue for years to come. Now, that means parts suppliers like Vishay are going to book increasingly higher revenue, so let's put that one on the table to look at later. Here, Matthew is looking at single-family REITs on the idea that home prices have jumped so much and just priced a lot of people out of the market, forcing them to rent instead of buy. And to this, I would also add the apartment REITs as beneficiaries as well, although I am a little worried about the effect of the moratorium coming off on those evictions and the foreclosures, as those came off just last week. Shares of American Homes for Rent, ticker AMH, are up 96% in the last 5 years, really jumping over the last year. Avalon Bay Communities, ticker AVB, in that apartment space has also done really well with its 2.8% dividend and producing a 57% total return in 5 years. But here I think I want to wait just a few months to see how the businesses react to that end of those eviction moratoriums to see what management says maybe in the third quarter earnings reports before I jump into these. Now, I think that way you still get that longer term potential in that housing market pricing idea, but take some of that near-term risk off the table. Trevor is looking at that cybersecurity theme, and this is something we've been talking a lot about on the channel, that ever-present need for online security. He's got a few ideas here in the leaders: Palo Alto Networks, ticker PANW, CrowdStrike, and Zscaler, ticker ZS, which I recommended in January of last year, now up 450% in the last 18 months. This is definitely a theme you want to be in over the next decade and even further out. All the stocks here, though, have jumped higher over the past year, so I'm a little worried about valuations right now. For example, Palo Alto Networks is about the cheapest of the group, and even that trades for 10 times sales. Now, I do still own shares of Zscaler in my own portfolio, but might wait for a better entry point before adding more. John brings up an interesting theme here: the food companies, on that idea that everyone's going back to tailgating and concerts soon. And I could see this working out for those food service companies on that return to workplace cafeterias as well. So maybe stocks like Cisco Corporation, ticker SYI, or Performance Food Group, ticker PFGC. Some great ideas here, and a big shout out to all you that responded in our Facebook group. For our first stock here, we're buying Vishay Intertechnology, ticker VSH, on that theme in semiconductor demand. Vishay produces a broad line of semiconductors and passive electronic components, all of which should see rising demand as that Internet of Things, 5G, and the tech revolution unfolds. The company grew revenue by 24% last quarter, and Vishay is a net cash positive company with $781 million in balance sheet cash against just $556 million in debt. So lots of that financial flexibility for acquisitions or growth. The average analyst target of $25 a share puts it right back near that April high and up almost 20% from here. But like all of these, this is a long-term growth stock. Cisco Corporation's ticker SYY could also do well in that back-to-work recovery and pays a 2.6% dividend yield. The shares here have pulled back about 15% from the May high, but could bounce back by the end of the year if employers are able to get those people back into the office. Revenue is still a little shaky, but the company has a strong cash position and a history of growing its dividend with a growth rate of 8.6% annually over the last 5 years. And this is another one where the average analyst target of $86.90 a share puts it right back towards that recent high and 18% from the current price. This company is a leader in food distribution to cafeterias and that food away from home industry, so should continue to benefit as everyone gets out of their house. Next here is a theme I've been following, and Kelly Services, ticker KELYA, the $856 million staffing firm. I've been recommending shares of Robert Half International since March on that idea that as employers struggle to fill those open positions, they're going to have to turn to those staffing firms more and more over the next year. Their shares of RHI jumped 10% on the 23rd when it reported its earnings, and I think some of these other staffing firms could be next. Shares are down 18% from the May high, despite expectations for revenue to jump 13% this year to $5.1 billion. Now, this is another net cash positive company with $239 million in cash versus just $83 million in debt, so some good stability here as well. The average analyst target of $30 a share puts this one 41% from the current price, and I think it's soon that you get that pop on the earnings. Click on the video to the right for the top 5 real estate stocks to buy, the 5 REITs I'm watching in one of my favorite sectors right now. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.